everybody celebrate. The recession that we have been worried about for so many months has officially been called off. NPR is reporting that the Federal Reserve Chairman provided Congress with an update on the struggling U.S. economy. The Fed forecast he summarized called for very slow growth, but no recession. Reuters reported that the U.S. economy may have avoided a recession, but will grow below trend for some time as firms face higher prices for a range of goods that will cut into profits. And CNN just released an article with this headline: recession risk up, but still not likely. Yep, the US and global economy is recovering. Crisis averted. Things were concerning for a little while, but now the worst is officially over, and it's game on for stocks and crypto and all that stuff that people do. In fact, I'd be surprised if we ever had a stock market downturn ever again. But wait, hold on one second. What were some of those charts that we were just seeing? Wait, zoom it, enhance. Oh my God, all that stuff that I just talked about was from 2008. That's strange. I must have gotten confused. It must have been the Quaaludes. So, but wait a second. If all of that was from 2008, does that mean in the lead up to the biggest stock market disaster that has occurred in the last 60 plus years, that in fact, people were becoming increasingly optimistic about the economy? Because we do know what happened in 2008. The market crashed, consumer confidence crashed again, the whole world went into a deep recession. I'm pretty sure Goldman Sachs tried to sell the entire country of Greece. I'm hazy on the details. The damage that happened that year, we still haven't fully recovered from it yet. But you know, I think I understand now why I got confused, and it wasn't because of all the drinking. The patterns that we saw in 2008 are actually kind of similar to what we're seeing in 2023. In late May, Investopedia published an article titled, and I quote, "The recession keeps getting postponed. It may never come." The Economic Outlook Group sent a note on June 29th basically stating, "Ladies and gentlemen, the recession has been canceled." And on July 19th, the New York Times published this: "The year is more than half over and the recession is nowhere to be found, not certainly in the job market, as the unemployment rate is hovering near a 5-decade low, not in consumer spending, which continues to grow, nor in corporate profits, which remain robust. Not even in the housing market, the industry that is usually most sensitive to rising interest rates, which has shown signs of stabilizing after slumping last year." And more good news came out showing that, like in 2008, consumer confidence has been bouncing off of its lows over the last few months. And of course, if you've been watching the stock market, it has been climbing from September, October lows in 2022 and has just climbed for the last 10 months. And this is all despite concerns about a recession, rising interest rates, even 3 of the 5 biggest bank failures in history. Now, I'm not drawing comparisons between now and 2008 because I'm worried about some sort of financial Armageddon. I'm doing it to point out that sometimes what the media reports on does not line up with, reality. I'm not a fortune teller, but all the data seem to be pointing to us still heading towards a recession and not, as the Fed calls it, a soft landing. So in this video, I'm going to give you 3 of the biggest indicators that seem to suggest that the global economy is still on the path toward a recession. And at the end of the video, I'm going to try to give you some concrete advice for what you can do to prepare either your wealth or your portfolios for it. Hi, I'm Sean MacIntyre, your personal wealth Sherpa for the duration of this video. So quick definition here, a recession is just a deep, long, and widespread drop in GDP. So if we want to know what could potentially cause a recession, we just have to look for the things that make up the US GDP and what makes it go up or down. And what makes up 16.4% of the GDP? It's going to be corporate earnings. And right now, as I'm recording this video in September of 2023, corporate earnings are expected to drop like 7%. Right now, analysts and economists are gearing up for the biggest drop in corporate earnings since 2020, like the pandemic. Even more dramatic than that, right now, analysts are not expecting any S&P 500 company, like the big companies in the US, to see any revenue growth year over year whatsoever for the first time in like 2.5 years. So there are really 2 reasons why corporate profits are probably going to go down. One is simply people buying less stuff. Companies can't make revenue if they aren't selling anything. And secondly, the other part of the corporate ledger, which is expenses. If companies, like actual cost of doing business, possibly as a result of inflation, is going up, well, that's going to eat into their profits, their earnings. So guess what? In 2022, we saw inflation push input costs higher. The cost for commodities is going higher. At the same time, interest rates from the Fed are going way up, which is making it harder and harder for companies and individuals to take on debt to buy stuff. And if you want a simple rundown of what inflation even is, or what makes it go up or down, or how the Fed interest rates actually affect it, check out this video that I did here, because that's going to give you some insight into what we can expect over the coming years when it comes to that. But an interesting statistic that's worth looking at when it comes to how much people are buying or how much companies are actually generating in terms of like revenue and profits is cardboard boxes. Cardboard boxes give us an insight into pretty much like every single step of the international supply chain, from digging stuff out of the ground to shipping components to shipping stuff to your doorstep via Amazon. For that reason, sales of cardboard boxes are a pretty good indicator of consumer demand at that moment. And right now, the industry that makes corrugated products like cardboard boxes is seeing slumping sales. Shipments of empty boxes are down significantly. In fact, cardboard box sales have slumped to lows not seen since the 2008 Great Recession. There's another fun little parallel for you. We can also see evidence of this decrease in demand having ramifications on corporate profits by looking at shipping containers. Apparently, container rates on 8 of the major supply routes around the world has seen a 75% drop. Consumer spending on international goods has just plummeted. And so as a result, businesses aren't spending money to ship stuff overseas as much anymore. Simply put, corporations are seeing less activity, and that suggests that a slowdown might actually be on the way. But here's an even bigger reason why a global recession seems pretty likely right now, especially in the US. If corporations account for 16.4% of GDP, then the government accounts for a massively bigger portion. So on average, US government spending accounts for about 25% of the US GDP. In 2020, due to the coronavirus pandemic and stimulus and all that actually shot up to 31%. But in early 2022, the cessation of like COVID relief programs and other government spending on vaccines and masks and stuff like that actually led to a decrease in government spending. And the GDP decline that we saw then, that everybody was calling a recession, and Biden changed the definition of recession, that was just a result of the government spending less. For something to qualify as a recession, it's not just GDP go down. It actually has to be somewhat severe and widespread through the economy. And what we saw in early 2022 was the government just being like, that extra money that we were spending, we're going to spend not that anymore. But in 2023, the issue is different. US government spending is hovering around an average right now of 24.6%. And during the debt showdown in June, politicians agreed to basically cut $136 billion from government spending. They also agreed to a 2-year spending cap. The Conservative Party in the United States, the Republicans, they want to see even additional reductions in spending. Some people are even calling for a government shutdown, as we saw in 2018, 2013, and 1995. And guess what? The government can't really cut as many checks if the government shut down. And I don't know if you were involved in the stock market back then, but the government shutdown in December of 2018 coincided with a really sharp drop in the stock market. Listen, reduced government spending can certainly be the catalyst that results in a stock crash or an economic recession. I need to clarify a misconception that people have. A lot of investors actually think that during a recession, credit card companies tend to suffer the most. This misconception stems from the notion that when economic times are tough, people close their wallets and don't spend as much. They try to batten down the hatches and save. But this doesn't line up with how people actually behave. When jobs are lost and wages don't go up with inflation, people start taking on more debt because they have to use credit cards to start paying for daily expenditures like groceries and stuff like that. We've actually already seen this process begin over the last few years. Most lower income households are believed to have been completely depleted of their excess savings that they had racked up during the COVID-19 pandemic. At the same time, consumer debt has skyrocketed. Consumer debt has soared up to $5 trillion, while the actual money that people have saved or stocked away has dropped below $1 trillion. This situation is actually worse than it was before the coronavirus pandemic. At the same time, US workers have seen an uptick in wages, but it hasn't been keeping pace with inflation. According to Forbes, a survey of US companies conducted in early 2022 reported employers were budgeting an overall average salary increase of 3.4%, which was less than half of then current inflation rate of 7.9%. At year end, another WTW survey reported the average US salary increase grew to 4.2%, but still a third below the 2022 US inflation rate of 6.4%. Americans are 1. making less money. 2, taking on more debt to cover bills and expenses. And 3, the cost of that debt is going up as the Fed continues to hike interest rates. On top of all this, the student loan forgiveness thing that happened, the $2 trillion-ish in student debt that exists out there, that pause has been put on hold. And by that, I mean people are going to have to start paying that back again. So 10% of the US population, the educated US population, is about to see their bills massively increase. Right now, estimates suggest that just the student debt thing alone is going to reduce consumer spending by 0.1%, which is going to have a 0.07% reduction in GDP. And that's just the student debt thing. There's all these other costs that are racking up too that is going to put downward pressure on what consumers are actually able to spend. And that's a really big deal. That's just a really big deal because consumer spending, it's about 67.9% of the US economy. If consumers run out of money, that's over half of the US economy that's just oh well. So let's face facts for a moment. Even though things look good on the surface and Bidenomics is a W or whatever, there are still plenty of reasons to be concerned about the economy over the next 12 months. So we should invest, but carefully. Now, some viewers who saw my videos in 2022 might be like, hey, Sean, you're flip-flopping. You said that markets would go up in 2023. And I did say that pretty much throughout the last 6 months of 2022. A lot of my general predictions about where the stock market would go this year have kind of come true. But I also made a crucial comparison to a couple of important years. The macro conditions of the economy and the way that affects the stock market look very similar to 1974 and 1975. The market had a catastrophic crash in 1974. Just like it did in 2022. But the market also started to recover towards the end of the year, just like it did in 2022. The recovery continued through the first 7 months of 1975, just like 2023. And even though the year of 1975 ended with pretty sizable gains, the market fell from its highs in 1975 and descended for the final few months of 1975. The fall wasn't as bad as 1974, but for people who bought at the top of 1975 thinking oh, yay, the bear market's over, recovery, well, they got clobbered. Now listen, market predictions are stupid and anybody who makes them is a big fat doo-doo head. But if I had to make an educated guess, I'm going to say that we're probably going to see a similar situation in late 2023. Expect the market to either be flat, volatile, or to trend sort of down. I mean, that lines up with what JP Morgan analysts think, not that you should pay attention to Wall Street analysts, but they suspect that the S&P 500 is going to drop about 5% from where we are right now. In fact, the market has already dropped pretty much that amount since they published that figure. Now, most investors are probably going to be scared of investing due to that prospect, but smart viewers of this channel should understand that there's a big opportunity. They know that pullbacks in the market is an excellent opportunity to buy cheap shares of world-class companies that are going to survive whatever recessions throw at them. But if you really want to protect yourself from a recession, I'm going to give you 4 pieces of advice that I want you to follow. And this is going to help you whether there's a recession or not. It's just going to help you build wealth over time. First thing, focus on preservation over profit. Now is a really good time to start putting aside a big chunk of your money towards a very liquid emergency fund. That's cash, high yield savings account, short-term treasuries, things like that. If there's going to be a recession, the odds of you losing your job, they're going to go up over the coming months. So make sure that you have an emergency fund to cover at least 6 months of expenses going into that. The next thing I want you to do, especially if you're a stock investor, is to focus on the things that are going to increase the actual income and cash pool that you have available to invest. So what does that mean? That means dividend stocks, that means selling put and call options, doing things that actually generate income in your retirement accounts. What you can do is then use that money that you're pooling up as a result of contributions or income that you're getting from your investments, and you have a steadily growing pool that you can then deploy as dry powder to buy up cheap shares of stocks that you want to own anyway. The third thing that also applies for investors, don't rush into growth stocks. Growth stocks have gone up, and we see cyclically that when growth stocks go up, and value stocks and dividend paying stocks go down, there tends to be a reversal, and then, income generating stocks outperform and growth stocks tend to underperform. So wait for the next cycle and just hold off until there's a sharp pullback in growth stocks before you invest in those. And if you're looking for a lengthy report on what to do in the event of a recession, I actually put a huge amount of information, taking from a lot of studies and taking from a lot of research that just actually shows what tends to do well in the lead up to or during a recession. That's on patreon.com/DIYwealth, but I'll just give you a quick synopsis of it. Bonds, gold, consumer staple stocks like Procter & Gamble and other things like that, and farmland. And there are certainly stocks that allow you to get access to farmland. So the correct emotion to feel right now is cautious optimism. Be excited about the market pulling back a little bit and offering some good deals, but be conservative about getting into the market right this second. You don't have to do it all at once. Long term, you're not going to miss out on very much money if you don't time the market perfectly. So stay invested, but amass some cash on the sidelines if you can. And listen, I don't want a recession to happen. Recessions suck nuts. I actually hope that I'm wrong in this video and the US and global economy never experience a recession again. But markets don't run on hope. They run on cash. And the cash, it's disappearing. So let's avoid seeing our cash disappear by being too risky in this particular investment environment. And if you want more tips, tricks, feedback, information about how economics works, but explained as simply as I possibly can make it, check out this video next.